Welcome to Subramani. Lot of questions from advisors, from investors saying what to do with such volatile markets. So the thing is, many people who have started new have forgotten that the markets don't always only go up. If the market were to only go up, all the money would be here and the returns would come down to 7%, which you get in your National Savings Certificate or PPF equivalents, right? If there was that kind of an assured return. There's no assured return. The fact is you're getting 24% and 42% in certain years, because you will also have minus 14% and minus 18% in some years. So all of that together is the market. But after a few years of great positive returns, we forget that markets can also go down. And we also know that past performance is not an indicator of future performance, but past performance should be analyzed. You should learn from history, right? You know history at least rhymes, even if it does not repeat. So I said, let us look at some data, and I found some very interesting data. So annual dips, right from the 1980s, historically, the index has definitely dropped every year by 10% and recovered 10%. So when you see it at the end of the year, you see, oh, market didn't do anything. But it's not that the market didn't do anything. Market fell 10% and recovered 10%. So you could have lost money. You may have bought at a high, not sold at a low, and then worried, then the market went up, so you actually missed out on opportunity. All these things can happen, because when you look at data, you look at data collectively, right? Like you look at 1991, 92, 93, 94, then the fall does not hit you. Because you say, oh, market went up by 265%, it had to fall 40%. It had to. There's no such thing, because if you take the data from say 2002 to 2007, 2008, it is impossible to believe that the market had only big positive returns during that period. So I thought I'll go and look at the American data, seeing how it is. So since the 80s, in every year the S&P has dropped from a peak to a bottom, obviously, and sometimes it's a few percentage points, and sometimes it is as down as 49%. So I just thought market corrections, which means 1,000-point fall in the S&P or things like that, would be quite a bit. In fact, there are 38 market corrections, and market corrections is to be a decline of 10%. So 10% fall since the 1950s till 2021-22 has been 38 market corrections. So every market correction, if you reacted, you could have got hurt really bad. So, and they also say that in the US the data is every 1.5 years, actually almost 2 years, the market definitely falls. So here let us give it clear words: market crashes. So this data is coming from Morningstar, Investopedia, Value Research, right? So from 2-3 places, and obviously most of the data is foreign, so Value Research may not have done much for this particular episode, but yeah, data comes from all these places. So let me just show you, let me just tell you the crashes which happened. Okay, when I'm talking of a crash, I'm talking of at least a 20% fall, right? So 1903, go back more than 100 years, there was something called a rich man's panic, where the market fell 22%. I do not know much about it. 1906 was a general panic where the market fell 34%. 1911, you can guess, World War I, market fell 51%. 1929, of course, everybody knows, Great Depression, market fell 79%. Hold your breath, 79%. Have I seen such a fall in India? Not 79%, but 49%. I think 93 or 94, just after the Harshad boom, right? At least 40 to 45% kind of a fall. I don't remember exactly. 1937, you can guess, World War II, and 50% fall. Post-war bear market, 1946, the war was just over, then people didn't know what to do, so again market fell, I think 37%. 1961 Cold War Cuban Missile Crisis, John Kennedy times, market fell 23%. 1966 recession, 22%. 1968 inflation, bear market of 36%. Just imagine these two have to be taken together. 1966 the market fell 22%, and 1968 the inflation bear market was 36%, and 1972 inflation, Vietnam War and Watergate 52%. Just imagine somebody who had come in 1965 would have lost 22% in 1966, maybe 1967 was a little bit of recovery, again 1968 you would have lost 36%, and in 1972 you would have lost 52%. So before you ask your father, grandfather, somebody saying why didn't you invest in the market, remember market was not a safe place, there was huge losses which were happening, right? So this we are still talking crashes. So 1980 stagflation, 27% fall. 1987 all of us remember Black Monday, where the market fell 30%. Then 1990 Iraq and Kuwait war, market fell 20%. Then 2000 .com crash, 50% fall, 49% fall in the market. 2007-8 we remember housing crisis. 2020 COVID, again market fell 34%. Now when the market falls so viciously, it wipes out a part of your capital, big part of your capital. Sometimes when it's a 50% fall, it scares you. And if people around your house have been saying, I told you don't put money in the market, they just pile on you, and you are really going to be screwed, right? Then there is also flat markets. Again, this is available in Investopedia from the historical data that Investopedia has. It's more than a market cycle. It is every 20 years the market's gone flat for an extended period. I think some more research has been done now showing how if you adjust for inflation, it is not true that equity outperforms bond every decade or things like that. There have been decades when the debt has outperformed the equity by a mile. So take 1906 to 1924, 19-year flat market cycle. You have come through a 19-year flat market cycle. 1929 to 1952, again hold your breath, 1929 to 1952 is a 24-year flat market. 1966 to 1978, 13 years flat market. 2000 to 2012 flat market, right? That is what US market did. So there are times, so understand one thing, there is nothing called a perfect investment. If you look at my portfolio, you could say, oh my God, you're Rakesh Jhunjhunwala's classmate, you're a disgrace to that class. Correct, I'm a disgrace to that class if I compare myself to Rakesh Jhunjhunwala. But you're not looking for the perfect strategy, perfect investment strategy, perfect asset allocation strategy. It does not exist. What suits you, suits you. What suits me, suits me. What suited Rakesh Jhunjhunwala is what Rakesh Jhunjhunwala did. Even if you take Rakesh Jhunjhunwala's portfolio, he made money on the concentrated bets that he had. Maybe 6 or 7 of those shares where he made money. He must have bought say 100, 200 shares, 300 shares. What made money was a very small concentrated portfolio. You get a concentrated portfolio only by making a big portfolio. So I think Gopal Agarwal of HDFC Mutual Fund says that you can buy 200 shares, but ultimately you will make money in the top 20, 30. So you have to buy a lot more and then keep eliminating, saying this is not good, this is not good, this is not good. That also happens, right? So if you are really worried about a potential market dip or crash or flat market cycle, consider some of these strategies. Consider products which are capital protected, savings bank account, your bank FD, your liquid fund, right? So right now I think even a gilt fund, given the interest rates, will only go down further. If the interest rates won't go up, gilt also may not be bad, but I'm not talking of that as a capital protected product. Fixed deposits, annuities, these are good capital protected products, and if that is big chunk, that has to be the foundation of your house. The annuities, that has to be the foundation of your house. You know, whatever happens, whatever the storm, the foundation should not shake, right? Whatever the earthquake. So annuities can create income streams for you. Gold, right now gold is at its peak, perhaps may not be a great time to be investing, but for those people who have done an SIP in gold last 5-7 years, it has been very profitable. Also remember, you can access the cash value of your insurance. I have at least 2-3 crores lying in ULIP which are almost mature, maybe 2 years away, 3 years away from maturity, and so that cash is always available. Then any investment or product which is a link, which is like a hybrid fund, some equity and some debt, so that the debt gives you assurance that things won't go too bad, and equity so that when the market goes up you participate at least partially. Second, the diversification across markets, across caps, large cap, mid cap, small cap, maybe US equity, maybe REITs, international REITs, gold, silver, debt. When you put in all this, then just the fall in equity in one part of the world should not hurt you too bad. So, I mean, let me repeat, there's nothing called a perfect investment. Don't bother too much about looking for that perfect investment. If you can sleep well and eat well while building the portfolio and while living off it, you have done very well. Don't worry too much. But this history was necessary so that people understand that markets are not some one-way street like this. It looks like a one-way street much later when you're watching it. But when you're sitting in the roller coaster, it doesn't look so simple. Thank you.